Welcome to the latest episode of Damien's Market Update, which is the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, June has brought the curtain down on the first half of 2024. So my last show was done at the back end of June, and with the exception of high yield bonds, most bond sectors finished the first half of 2024 in positive territory. But despite some analysts predicting that 2024 would actually be the year of bonds bouncing back, we've not seen that as such, although, as I say, they are in positive territory. But by contrast, stock markets were on a tear in the first half of the year, and we've seen that continue somewhat into July. Now, if you go back to the start of the year, investment banks were predicting on average that the S&P 500 in America would finish the year around about 4820. Now, by the start of July, the S&P 500 was already at 5,400, which equated to a return of over 16% in the first 6 months of this year. But it didn't stop there. Now, at the time of making this video, we are already at 5,500. We did get as high as 5,667 in mid-July, and the US stock market, the S&P 500, and plenty of other stock markets across the globe made new all-time highs along the way. Now, the rally in US stocks resulted in investment banks upping their end-of-year targets. So, for example, JP Morgan, which was one of the most cautious investment banks at the start of the year, which had a prediction at that point of 4,300 for the end-of-year target for the S&P 500, ended up upping its end-of-year target to 5,317 versus predictions of 5,600 from the more bullish investment banks. And when I say the more bullish, the ones that were more bullish at the start of the year. And it means that the more cautious investment banks have become less cautious as the year's gone on, and those that were most bullish have become more cautious as the year goes on. And their predictions have started to converge towards 5,500, which, as I say, is where we roughly find ourselves as I make this video. Now, interestingly, the average full-year return for a US election year like this year is an impressive 11%. So in 2024, we've already surpassed that and then some. So is it as good as it gets for 2024? Have we had all of the gains we can expect, and is it going to turn sour? Now, July did get off on a positive note, with most global stock markets pushing higher, and as I say, many of them were setting new all-time highs. But investors' nerves finally began to be tested in the last couple of weeks. Now, last week in particular was the worst week for the S&P 500 and the tech-heavy Nasdaq 100 since April. And interestingly, at the same time as the Nasdaq 100 slumped, the Russell 2000, which is a small cap index in America, actually surged. And now the narrative that most commentators settled upon to try and explain what was going on was that investors were betting that rate cuts would stimulate the US economy and therefore provide a boost to the underperforming stocks. So they bought the market laggards effectively and ditched the high-flying tech stocks. Now that all seems slightly strange in terms of reasoning, but the market rotations that we've seen aren't necessarily a bad thing for bull markets. In fact, rotations are a good thing. It's when investors flock from stocks into safer assets such as cash that bull markets are usually under threat. And we have been enjoying a bull market. In the first half of this year, if I look at the numbers here, the Nikkei 225 was up 18.5%, followed by the Nasdaq 100 as one of the next best performing stock markets, up 17%. The All Country World Index, which obviously is a broad measure of how well stock markets have been doing, up 12%. If you go down to the lower or underperforming stock market, the FTSE 100 was up 5.5% by the start of July, and the Dow Jones Industrial Average is the US stock market that was lagging because of the lack of tech exposure, and that was up 1.82%. So we've had a bull market for US stocks, but in the last week, we've had a bit of a distraction to occupy investors. Now, in recent months, you will recall from these videos that there has been a significant impact on the performance of stock markets coming from politics, and that's from certain stock markets at various times. We had India, we obviously had European stocks, and we had a little bit in the UK. And up until now, the US stock market has largely been spared this politically induced volatility. However, the failed assassination attempt on former US President Donald Trump dramatically changed that. So after that shooting, Trump's odds of winning the US election rocketed to a 75% chance of winning, while those of Joe Biden slumped. And his odds already were falling anyway because of those disastrous public appearances, including where he called Ukraine's President Putin. So the chances of the Democrats winning the election were already falling, even to the point where some of their biggest supporters were calling for Biden to pull out of the race. It meant that investment markets suddenly started pricing in a Trump victory in this year's US election. So the Trump trade was back. Long-term investors might recall the Trump trade during the Republicans' previous term as US president. And broadly speaking, it involved a stronger US dollar, the dumping of bonds, and equity investors rotating out of defensive sectors into cyclical sectors. Those are the sectors most sensitive to the health of the US economy. Now, the market narrative at the time was that Trump would unleash huge amounts of fiscal stimulus, so that's like government spending, in a bid to make America great again. Now, the logic was that this would lead to economic growth, higher inflation and higher interest rates, which is why bonds were dumped and equity investors favoured economically sensitive sectors in the US, such as bank stocks and actually small cap stocks. So last week we saw some aggressive market movements as a result of Trump's shortening victory odds, and we saw the acceleration of the rotation into small cap stocks, with the Russell 2000 enjoying an 8% rally in just 10 days. At the same time, the Nasdaq 100 slumped by more than 4%, so that was something that shocked investors. Now, this followed a similar pattern to what we saw back in 2016 with smaller caps outperforming, but that is largely where the similarity with the Trump trade of the past ended, well, at least for now. But that's because bond yields held fairly steady while the US dollar actually weakened slightly. So perhaps the US Federal Reserve's war on inflation has actually overpowered the belief that Trump will ultimately stoke inflation again. Or maybe it's because Trump has been more focused on attacking his political opponents rather than talking about his economic plans. Who knows? But Trump's impact has already been felt overseas. So the trade war with China was a core policy of Trump's first presidency. And now the increased likelihood of a Trump election win has brought the possibility of an escalation in the trade war tensions back into focus. And so the market was already rattled by the current US government's warning that it was considering using severe trade curbs on companies providing semiconductors to China. But Trump's comments last week that Taiwan, which is obviously pivotal in the global microchip industry, should pay for the protection that the US provides against Chinese invasion, shook the semiconductor market. So Nvidia's share price slumped 7.5% last week, which actually sent the S&P 500 and the Nasdaq 100 to their worst two-day slump since April. And that is somewhat unsurprising given its influence on those markets. So Trump hasn't been good for stocks so far, even though he seemed to be during his last presidency. Also, negative sound bites over the future funding of Ukraine's war with Russia hit European stocks, and they slumped more than 4% last week. And that's despite the European Central Bank keeping interest rates on hold and suggesting that a rate cut was still possible in September. And it means that even if the Trump trade is difficult to pin down at the moment, it seems slightly muddied, even if it does seem to be in the background, it's already showing up as bad news for Chinese stocks, European stocks and big chip makers. Now, you've got to bear in mind that with each soundbite that Trump produces in the coming months, the winners and losers in any potential Trump trade will likely change, but they should eventually become clearer. But having said all that, and having seen people starting to try and play a potential Trump trade, the news that Joe Biden was actually going to step aside and let Kamala Harris take on Donald Trump in the US election this year saw the waters muddied even further. So investors began to question their eagerness to jump into the Trump trade last week. So following Biden's news, European stocks rallied broadly about 1% yesterday, as did US stocks, while Nvidia's share price jumped over 4% in 24 hours. So, of course, US politics aren't the only contributing factor at the moment, but one thing is for certain: in the last 10 days, it's given us a taste of the volatility that the US election is going to cause in investment markets more widely going forward. And don't forget, there's more than 3 months of campaigning still to go. But despite the slight wobble in the last couple of weeks, as investors, we've rarely had it this good. We've had the strong bull market in the first half of this year, has started to bounce back even though there has been a slight wobble in July. If you look at most equity markets, they are back in positive territory as I make this video. What it is, it's a good reminder that markets can't go up forever. And even though we have been seeing new all-time highs on stock markets, even gold has got in on the act as the hope of Fed rate cuts has hurt the US dollar. So unsurprisingly, my 50k portfolio that I run on 80/20 Investor, which you can see if you take out a free trial, has hit its own new all-time highs, and perhaps you've seen your own portfolios do the very same. But that recent stock market wobble we've seen should just be a reminder to stay humble, because things can't go on forever. They won't just keep going up and up and up. Now, despite all the positivity that you've heard in this video, there is one fly in the ointment for UK investors, and that's the pound strengthening against the US dollar, for example. And that's been because partly the Fed rate cuts have hurt the US dollar, it's caused it to weaken, but also the positive news about economic growth in the UK, but also political stability has seen people starting to back sterling. So we've actually seen the pound rally towards $1.30, which is one of the highest levels in nearly a year. And obviously that hurts any overseas holdings that you have in the US. So if you have, for example, US equity funds in your portfolio, you would have seen your returns take a little bit of a knock despite the rebound you've seen in the last month in the actual value in dollar terms of those equity funds. Similarly, the pound has rallied against the euro, and that's partly because of the problems in France regarding the French election. While the French voters did reject the far right, the country is now trying to actually form a government, so the euro has fallen versus the pound. So you will see a negative impact on your returns on European equities, although European equities have seen a little bit of a slump when you convert any returns back to sterling. But as investors, you can't have everything your own way. So that is it for this month on Damien's Market Update, that hopefully giving you a good overview of what is going on. It's a broadly positive picture with most areas of your portfolio contributing to your overall positive returns. If you've got any questions, then do please leave them in the comments of this video, but also please do like and subscribe to the channel.